Moving on to the long put butterfly. The long put butterfly is very similar in methodology and thought process of the long call butterfly, in that it's a neutral strategy implemented with the expectation that the underlying will become range bound. We're going to implement this in a high implied volatility environment to take advantage of the contraction in that vega. The spreads are going to trade cheaper because the in-the-money options will trade closer to the intrinsic value. The selling at the money covers a higher percentage of both of the long options. Remember that at the money options will carry a lot of vega. The further away you go, the less they will. Keep in mind that the at the money options will carry a high rate of vega. And building the long put butterfly, we are going to buy one long out of the money put. We're going to sell two at the money puts, and we're going to get long one in the money put. And generally the trader of this strategy is looking to implement this in a high implied volatility environment where the underlying is expected to settle into a tight range or trade at the price of the at the money put. We don't want this moving to our wings in this. When we are long, we want it to settle into a range and sit pretty, watch that vega contraction, and that's where our money is going to be made. The max profit is the difference between the short put and the long put minus the premiums paid and minus commission, and it's going to be achieved when our underlying pins right at those short puts. The max loss, well, the max loss is always our net premium paid plus the commissions. Anytime you're long or you pay a debit, you are locking in your max loss. And the break even has to the higher long strike price minus the net premium paid, or the lower put strike price plus the premium paid. Here's an example of our long put butterfly. Keep in mind our graph shows twice as much risk, and so our profit and losses are doubled. The reason being is I did one as a butterfly, and then underneath that I showed you the legs so that you can get a visual representation as to what each strike price was and what we paid for it. In this, we did the butterfly, we did the 65, 62 and a half, 60 put butterfly, and on this we paid a debit of 50 cents, which is $50. Remember, because the underlying is 100 contracts, we multiply our debits and credits by 100. As you can see below on the breakdown, the 60 puts, we paid $1.25, and then we sold two 62 and a half puts for $2.30. So remember, because we did two of those there on that particular strike, we need to double it. So $4.60 is totaled, and then we paid a total of $3.85 for the 65 put. So all of that being totaled, you take the $2.30 that we sold, we double that, $4.60 minus $1.25 minus $3.85, we have a debit of 50 cents. So our max loss on this is the debit we paid, $50. Our max profit is going to be the difference in the long put and our short put, which is $2.50, minus our debit, which is 50 cents. So our max profit is $2 or $200, because remember, it is 100 underlying, so you multiply every one of them by 100.
Sorry I missed you guys yesterday, but you know what I gotta say, if you can't take that, take it easy.